What's going on, everybody? Welcome back to the channel. I appreciate you stopping by, spending a few minutes of your time here with me tonight. Tonight, I want to go over some sell models with you. Really, the sell model that I'm following. All right. Naturally, like Stacy, I am short biased. All right, which means that my eyes see selling opportunities in the market a lot easier than buying opportunities. All right. I don't know why it's like that. That's just how I'm wired. Okay. That's just how my brain works. I also, on top of being short biased, I like to trade reversals. Okay. And that's what I want to go over with you today. I want to go over with you specifically sell models, reversals. Okay. And show you how I am identifying these things. I prepared some slides for you, and I also have some chart examples. Okay, so let's get right into this. Now, first things first, let's cover this. All right, just a little reminder, okay, that markets only do three things according to Stacy. All right, now, and I just want to give you a little extra something here. We all know what Stacy says, right? But another way that I like to think of this, the three things that markets do, right, is that any given day, the market is either going to give you a higher close than the open, a lower close than the open, or it will close relatively equal to where it opened. All right. But according to Stacy, markets only do three things. Okay. Breakout, pullback, continue, breakout, pullback, reverse, breakout, pullback, and enter a trading range. Now, notice that all three of these things always start with a breakout and a pullback. All right. So when we look here, we're looking at a breakout, pullback, continuation type of trade. All right. And we should see a breakout of a daily level, right? So in this example, we break out of the previous day's high, and then we pull back on top of that level, or we pull back right on top of the previous day's high. Okay. And then we engulf to the upside and continue that upward momentum. Okay. Here we're looking at a breakout, pullback, reversal type of scenario. Okay. In which we should break out, print some type of reversal pattern there after we break out, like an M at the high of the day, okay, a head and shoulders type of pattern, or an A top reversal type of pattern, okay, in the timing window of whatever session you're trading, and then engulf the traders that are trapped on the wrong side of the market, right? Meaning that once we break that daily level, we've triggered higher time frame traders into the market. Every green candle that's above that level is a place where traders are buying this market. Okay. Then we engulf all of those candles and then start trading to the downside. When we engulf that, we are trapping traders on the wrong side of the market and then taking them for a loss. That's why we go from one extreme of the range to the other. Okay. And in the last scenario, we have our breakout pullback trading range type of thing. Okay. This is where the market breaks out and then stays within the same general high and low range with no real directional progress. Okay. So we break out of that level, but then we just coil sideways at that level, never really going any higher or any lower. All right. And that can happen. Those are the types of days where traders, get chopped up no matter what direction they're trading. Okay. So we want to learn to avoid those types of days, which can be easier said than done. Okay. But what it comes down to is patience on the day. Maybe you take a more conservative entry. All right. But with experience, it will become easier for you to see these types of things. All right. When we have a reversal like this, we should break that level, and we should not spend very much time at that level before we reverse and go down. Same thing with the continuation. We should pull back to that level, but we should not spend a lot of time at that level once we break out before we continue upwards. All right. But in this type of scenario, we spend a lot of time chopping around that level. Okay. Now, for the sell model, the reversals, okay, We may need a little more patience and discipline to sit on our hands than other traders who are trading different setups, okay? But these opportunities are very consistent and lucrative, all right? The point is to know exactly what we're looking for, when we are looking for it, why we are looking for it, where we're looking for it, and how we will trade it, okay? So if we break this down, if we want to know exactly what we are looking for, what are we looking for? We're looking for this, right? Break out above the level, print some type of reversal pattern, and then swiftly start trading in the opposite direction. That is what we are looking for, all right? When are we looking for it? In a session timing window, all right? Why are we looking for it? Because we have higher time frame traders trapped on the wrong side of the market. This is why we are looking for these things to happen at these certain times, okay? Where are we looking for it? The levels, the previous day's high, or a different high, like the current day's high or the most recent high on the current day, all right? And how will we trade it? That has to do with your entries into the market, okay? Like if we have an M pattern at the high of the day on a 1 minute chart, we're getting in at the break of the middle structure of the M. Okay. If we're on our 5 minute chart, we're using the universal entry criteria, 5 minute engulfing candles, convincing 5 minute closes below the 20 period moving average. All right. If you're on a 15 minute chart, you're looking for pin hammers or engulfments. Okay. So that is how we will trade it. But the important thing is you want to master exactly what you're looking for. Okay. You need to understand all of these things, the who, what, where, why, when, how of it all. All right. Now, let's go over the daily process because this is really what you're going to be doing every single day. You're going to be following the same simple daily process. All right. The more simple you can make this in your mind, the easier it's going to be for you to repeat it. Therefore, the more consistency you will see in your trading. And we will always prioritize consistency over profits. All right. Or else you might make money, but you're going to end up giving it back because you don't have a consistent approach to the market. But if you prioritize your consistency, right, then you're going to be able to take your profits. You're going to be able to keep those profits without giving them back. All right. Now, every single day has a high and a low, right? Every single session has a high and a low. And that is what we are going to be tracking as a part of our daily process. So we already understand that we are using certain levels, right? Like maybe the previous weekly high and low or the previous daily high and low, all right? But we are also using the current day's high and low or the most recent high and low, okay? Now check out this example slide here. You can see right here, Tokyo gives us our opening range of the day, all right? We're going to mark off the high and low from that session and project it horizontally across our charts, all right? But when the London session comes around, it breaks out of the high of that Tokyo session and gives us a new high and low. So we are going to project those levels across our chart, and that sort of becomes our box. All right. Now, heading into the New York session, we break out of those London levels. Okay. And then immediately price trades down back into the range, retests that London high level, and then engulfs to the downside, eventually taking out the Tokyo lows. This is an ideal scenario, okay? Now, what I mean here, if we zoom in, you can see we come up, we break those levels, and then we immediately trade back below the level, pump up, retest the level, and then trade down. Now, this is just a generalization, okay? This pullback might go back up here above the level or whatever, okay? But the point is, this area right here that was once, some sort of resistance. Okay, we break through this resistance level from the London highs, trade back below it. That resistance level changes to a support level or whatever, where we bump into it. Okay, and then start trading down now. Okay, now days like this are common on the indexes where we have a narrow range throughout Tokyo and London, and then take out the high of the current day before selling off dramatically. All right. This sort of narrow range day is common on the indexes. This is our sideways coil. Okay. Then we may see a false break of the top of that coil and then reverse to the opposite side. But we're always trying to wait and see a level taken out, whether that's the previous day's high or the current day's high or the previous session's high or whatever it is. Okay. We still follow the same daily process by marking off the high and low of that coil, right? And then watching price action as we enter the New York timing window, right? And then this little extra tidbit here. Sometimes we will dump down just before the session and put in a low, okay? And then when New York opens, we pump up and pop the top. That's what I call it. We pop the top before selling off. And this right here is sort of like a micro master pattern template, right? Where we have a peak formation low, peak formation high, lower lows for a pump and dump type of scenario in that session. All right. And this happens pretty often where we will put in this low and then pump up. That low is usually put in place just before the session, like, anywhere from like 5, 6 a.m. to 7 a.m. and then into the session. Okay. So this would be like 5 or 6 in the morning. And then by 9:30 or 10 o'clock, we're putting in a peak formation high and starting to sell off. This is a more standard type of day where we have something like a Tokyo low and a London high as our box on the day. Okay, that would be our current high and low range on the current day. And we simply mark off these levels, the low of Tokyo and the high from London, and project them horizontally. Okay, train your eyes to move horizontally, and then we watch how price behaves as we enter the New York timing window. All right. So you can see we would come up after 9:30, take out the London highs, and then reverse and go the opposite direction. Okay. And a little pro tip for you. Remember, we always want to be identifying targets. Okay. So we might have a larger target like the Tokyo lows here, right? But we also can see that we have this sort of gap time low that is put in place, and then another low that's put in place kind of going into the session, all right? These lows can be your initial target, your anchor point, okay? Where we put in a low and start to pump up to take out that level, okay? Or we put in a low and start to pump up to take out that level. This would be like your initial target, all right? You can be comfortable, okay, depending on where you get in and how you like to trade, at shutting your trades down at these levels, okay? We're not always going to go straight from one side of the range to the other. But if you are waiting for a level to be hit, it's very likely that this market will trade all the way to the other side of the range because we have higher time frame traders trapped in this market. So you can see in this example, right, we're only looking at the current day's high and low. I don't have the previous day's high and low marked off. But even though we might not be taking out the previous day's high, we are still taking out the previous session's high, which triggers 4-hour traders into this market. Those are higher time frame traders. So we could see it go from one extreme of the current day's range to the other extreme of the current day's range. All right. We could also have this sort of standard variation of a Tokyo high, London low that forms our high and low range on the current day. Okay. Simply project these levels horizontally and inspect how price behaves in our New York timing window. And again, we will be identifying potential anchor points, potential targets to the left, okay? Anywhere where we put in a clear low and start to pump up, okay? Now, we can get even more specific with our high and low range because sometimes the current day's high and low can sort of trick us, right? Like if we're using the Tokyo lows and London highs, we can sort of miss this where we have this clear high and low range from London specifically, right? Price then dumps down, takes out the London lows, sort of sweeps that liquidity there, triggers those traders into the market, and then goes higher for overall a continuation pattern on the day. All right. If we were only using this Tokyo low, we would miss this sort of sweep of the London lows. We wouldn't even consider that. Okay, we would miss that. But then when we look back in hindsight, we would be able to say, oh, look, it's pretty obvious that we came down, we swept these lows from London and then continued higher. And it would make sense. Okay, so we just want to make sure we're marking the most recent high and low range prior to the New York Open, as well as the current day's high and low, as well as the previous day's high and low. Okay, does that make sense? You see what I'm saying? Now, I guess I threw this in like, okay. Yeah, so this would be your sell model, right? Over here, we have that continuation where we swept those London lows. Over here, we have the London low, London high, and then we pump up, take out those London highs, and then continue downward, okay? Now, it's possible we could come down and sweep those London lows, pump up, take out the London highs, and then reverse, okay? That could happen. Just because we sweep the London lows doesn't mean it's going to be a continuation pattern. That's not what I'm saying. All I'm saying is you also want to be marking off the most recent high and low before we get to the session, all right? Now, let's look at some chart examples. And these might be a little confusing. I'm hoping, though, that I can explain it to you, all right? So here's our New York Open. So you can see before that New York Open, we have a Tokyo low and a London high. We mark off those levels. And you can see going into the New York session, we have come up, we've taken out the current day's high, all right? This is a 15-minute chart too, by the way, okay? We take out that high. Eventually, we get this engulfment right here. We have all these wicks being thrown into the high of the current day, right? We engulf, we break through this little death line right here. This is a coil here at the high of the day. Okay, a pump, coil, and dump, okay? An hour up, an hour sideways, an hour down. We break that death line, you're in the market, all right? Now, we also have the most recent low and recent high going into the session. And when we pick the most recent high and low, we're not just, we want to see it should be a clear high and low. The more clear and obvious that high and low range is, the more of a well engineered chart you're looking at. Okay. You want your trades to be more or less obvious. Okay. How Stacy says, no stress, low thought. You want to not really have to think about this. You have a clear high and low range or a clear high and low range. Okay. We take out a level and reverse. Right. And this is also why it's important to have multiple targets. You don't always want to be aiming for these home run type of trades where we're going to go all the way down to the low of the day. Have, you know, other targets in mind. And you can see that, we put in this low or we put in this low and start pumping up, and we do come back right down into those levels. Right. So if your target was, more conservative, you're going to have a better win rate. Okay. If you're always aiming for a home run type of trade, it's less likely that you're going to hit your profit target consistently. All right. You should have multiple targets, if that makes sense. All right. And I did not put the names of these pairs that we're looking at on purpose. You don't really need to know what pair it is. Don't get distracted by that type of shit. We're looking at basic structure, okay? It's the same no matter what pair you're looking at. All right. So again, here's our New York session. We have our most recent high and low marked off, right? And you could use the wicks, who cares? But this is a 15-minute chart, okay? So we're using bodies, wicks, whatever, okay? Equal highs, equal lows. Here's your low and high of the current day, and here's the most recent high and low. And you can see we come right back up into those levels, chop sideways for a little bit, engulf, and then head down to the opposite side of the range, okay? And the more you look at this, the more you apply this daily process, the easier it's going to become for you. All right. And in general, you can see this large coil. We're going to be marking off these levels. Okay. Now, here, this is 2 different days. Okay. 2 different days. But here's our New York session. We have marked off this high and low range, this obvious high and low. Okay. And project those sideways. We also have the most recent high and low before the session opens, okay? And you can see we pump up, we take out the current day's high and reverse. We have a 3-bar reversal pattern here, this last green candle, and then 2 cell candles that engulf those levels up there. And then the very next day, you can see we do not take out the previous day's high. We just trade back into the previous day's high. So if you were only tracking the previous day's high and low and waiting for one of those levels to get hit, you're going to miss some opportunities, right? So on the second day, we have this early low. That's your low of the current day. And then we have this London high as your current high of the current day. Okay. And then we also have this most recent high and low range, and we've projected those levels horizontally. You can see heading into the New York session, we trade up, break through the current day's high, back into the previous day's high, and then reverse and take out these lows. And then here's an example of the more narrow Tokyo, London levels, a tight coil heading into New York. All right. So here's your low of the current day, your high of the current day, and your most recent high and low range before the session. And you can see we pump up, take out that high from London, and then reverse. Okay. You don't have to get in up here. You could wait for it to pull back into the EMA and then trade lower again. And then here we have a very early high of the day level put in place, an early low of the day put in place, and then here's our most recent high and low heading into the session. We pump up, take out the current day's high, and again, we do not take out the previous day's high. We take out the current day's high and reverse, okay? We pump up, coil sideways, and dump. Again, here we have these levels from previous sessions, you know, and this was a weird day. This high that's put in place, this is just before the session opened. This is like 8 o'clock or 7 o'clock, this high up here. But still, we have a high and low of the day, our most recent high and low. And you can see we pump up, take out that level, and reverse. Okay. Here, we have this, on this day, we have this tight coil heading into the New York session, right? So we have those levels marked off. And you can see we pump up, take those levels out, coil sideways, and dump. And if we zoom out, we see we have not the previous day, but the day before. So we have a very clear high and low range here from this high and this low. But on the current day, we are still following the simple daily process of marking off the current day's high and low, or the most recent high and low before the session opens. But this would have given you that extra confirmation, right? Because there's our coil. We take out the current day's high, which was put in place in Tokyo or London or whatever. Okay. We also have this high. We take that level out, coil sideways, and dump, okay? And you can see this, again, this is a 15-minute chart, but we have this 3-bar reversal pattern, the last green candle, and then the next 2 red candles that engulf that, okay? We close below the EMA, you're in the market. And then here, I just threw this little extra one in. This is a Tokyo session thing, but I just want to show you it works no matter what session you're trading. As long as you can identify a clear high and low range, okay, preferably from a session like this is the New York high and the New York low from the previous day. We project those levels horizontally and inspect how price behaves in the session timing window, okay? So this is Tokyo session. We pump up, we take out the previous day's New York session high, coil sideways. This is a 15-minute chart. So when you look right here, we have 1, 2, 3, 4, an entire hour of just chopping sideways once we take out this level, right? So we pump, coil, and dump. We have an hour up, an hour sideways, and then an hour down, okay? But the same simple stuff is here where we pump up, take out that high, and then reverse. When you're looking for sells, okay? If you're short bias and you're hunting reversals, this is what you want to see every single time. A clear high and low range, and then that high will be taken out and we reverse sharply from that level, okay? So I hope that this video makes some sense for you. Okay, I guess I do have another slide for you. Here, you can see the previous day has pumped up, closed, and breakout. Then we have that tight coil through Tokyo and London. So you can see we've marked off the high and low of that coil. And then just before the session, we have a high that's put in. So we have this low and this high as our most recent high and low range before the New York Open. It's a funky day, right? But we dump down, pump all the way back up, take out the current day's high, and engulf to the downside, right? And you're in that market, okay? Again, here's our New York Open, our most recent high and low range that's very clear. We have a clear low and a clear high. The market opens, we pump back up into that level. We're breaking the previous day's high as well, triggering daily time frame traders into this market. We coil sideways, take out that level, and then reverse, all right? You're looking for this every single day, okay? And this is actually the last slide. So I hope that this makes sense. If you guys need anything, if there's any questions that you have about this, drop them in the comment section. Join the Discord. All right, my name on Discord is Lost Sloth 1235. We can chat privately. We can chat in the group. We can set up a free one-on-one call to actually look at charts together personally and go over this process, okay? But until next time, I hope you continue to free your mind.